Hi, I'm Martin Pring. They say that a picture is worth 1,000 words, but I say that a chart is worth 1,000 pictures. And that's because charts in the financial markets often scream out very important messages that an important or significant trend reversal has taken place or is about to take place. Each month I publish a newsletter called the Intermarket Review, and each issue contains what I call the chart of the month. And that features a market that I think has just turned or is about to turn. So this series of videos aims at presenting these charts of the month. So if you're interested in them, please hit the subscribe button and you'll be brought up to speed on a regular basis. So without more ado, let's go to the chart room and see what's in store for this month. This month I'm taking a look at the Shanghai composite, because it appears to be leading the world lower. It actually peaked for the cycle way back in July of 2009 and has been trending lower ever since. Now you can see that it's violated its bull market trend line. Most of the time these breakouts work out, but there are always some that do not. In China's case, they're further along the business cycle than the US, and the central bank has been raising interest rates for a while. At some point that becomes a prescription for a bear market. And that's why I think last week's breakout will be a valid one. The downside objective from a trend line is measured by taking the maximum distance between the price and the line and projecting it in the direction of the breakout. In this case, of course, it would be a downward projection, and the objective, ironically, if it's achieved, would take the price back to the Shanghai Composite 2008 low. You can also see that both these momentum indicators are also in a bearish mode, and that adds to the validity of the downside breakout in the actual index. This chart shows the Shanghai on a daily basis, and last week's action looks to me as if the index completed a head and shoulders top. More proof of a likely drop ahead. Look also at the Bombay 200 in the bottom panel. It looks as if it's in the terminal phase of completing a top. That hasn't happened yet, but it's certainly something to look out for, as a completion would signal a primary bear market, in my opinion. Finally, the Dow has experienced 5 negative divergences with its 13-week rate of change. That's quite a lot, and usually indicates some under-the-hood problems. We need to see a confirmation from the price, though. Otherwise, how do we know that there won't be another divergence, or if the current ones will be cleared up? That's easy because these two lines indicate the potential for a giant wedge, a large pattern indicating narrowing volatility as we get a fine balance between buyers and sellers towards the apex of the wedge. If the sellers were to win out with a Friday close much below that of May 27, watch out on the downside. Note also that the rate of change in the bottom panel is also featuring this same narrowing pattern. With Shanghai leading the way, it's going to be interesting to see how the US market deals with this weakening global picture. If you've enjoyed this presentation, you might want to go to pring.com if you're not there already and download a sample copy of our Intermarket Review, a monthly roundup of the world's principal financial markets with a special emphasis on the US. We also look at global indicators, bonds, precious metals, currencies, and international markets using ETFs to execute our strategies as much as possible. You'll find unique indicators and intermarket relationships you cannot find anywhere else. In the meantime, thanks for watching and good luck and good charting.